Hi, everybody. I'm Ross Healy, the Chairman of Strategic Analysis Corporation. Welcome back to our new Friday Focus. That's our new SVA in Action series, which has replaced our previous long-running Fang Friday webcast. A quick reminder to everyone as to what SVA is. SVA, or Structural Valuation Analysis, is a balance sheet-based approach to the market which merges fundamental with technical analysis. The lines that you see on my charts are technical price-to-book breakpoints, and they apply equally to stocks and stock indices. The dotted lines are our measure of the intrinsic value of those stocks and the indices alike. If you'd like to learn more, please go to strategicanalysis.ca. Now, to today's business. In the mathematics underlying our analysis, we find that the market and stocks are broken up into 4 zones of what I might call growthiness, each separated by a specific price-to-book breakpoint. I am showing them here, and let me tell you that these breakpoints are very powerful support and resistance level, and they convey very useful trading information. But wait, Ross, you're showing 5 zones here. Can't you count? Well, yes I can, but I have to add something. If we have zones of growth, there has to be a place for stocks to go to die, and there is. It is called the blue zone, and it starts just below an adjusted price-to-book ratio of 0.6. How a stock gets to its own blue zone is a matter of different circumstances: mismanagement, bad luck, regulatory change, Donald Trump. But when a stock slides into its blue zone, it always means the same thing. There's something wrong with the balance sheet, or the market believes that there is something wrong with the balance sheet. When you see this market signal, my advice to you is to run. Don't walk. Run with your pink ticket. Sell first and ask questions later. Because you don't know what the real problem is, and in my experience, you will have a very hard time finding out until it's too late to save your wealth. What I'm saying is, and I hope that you understand it, okay, that there is such a thing as too cheap. Now, 2 things happen when a stock falls into its blue zone. First, the expected returns become sharply negative. And second, the volatility goes ballistic. Moves of 25 to 50% on the downside are common, and moves of 50% to 100% on the upside are almost equally common. That is because the market can't get a handle on the quality of the balance sheet. And when the market is really uncertain, price changes become wildly uncertain. If we get into a bear market, maybe thanks to the tariff wars, I'm sure that we will encounter many such companies. In doing so, you will run into an interesting paradox: terrifying risks, but followed by terrific opportunities. In my experience, it takes a lot of work to stay on top of these stocks, so generally I leave them to somebody else. Now, Baytex Energy and Allied Properties were 2 stocks that have recently fallen into their blue zones. And if you look at their charts, you can already see why prompt action was a good idea. In today's session, I will repeat what I said above. There is such a thing as too cheap. However, not all is bleak. After a time in what I might call purgatory, that is to say, the blue zone, companies may be able to pull things back together again. The fundamentals might change for the better. And the stock may try to reemerge over that 0.6 level, which we call, by the way, the blue price, into the land of the living. And when they do, one of the biggest and often fastest trading opportunities occur. The shares are, or the balance sheet rather, of the shares are reaffirmed. Okay, and what that means is that the market will carry those stocks back up towards their book value, their end price, which is that light line that you see on the chart. Now, as that is a gain of 66%, that is not something to be sneezed at. Very often following bear markets, we will see a number of companies reemerging from their blue zone. And that means that there are many, many opportunities there which come. But all that's in the future. It's not here now. So, in closing, I will repeat what I said above. There is such a thing as too cheap. And when a stock falls to that 40% to its book value, discount to its book value, it's giving you a significant warning of major risks ahead. The SVA methodology is very useful in the early identification and avoidance of them. But it can also, in the end, lead you to some spectacular opportunities. Anyway, that's it for now. Have a great week, and I will see you next Friday.